Hey, real estate investors. If you haven't heard, crypto is reshaping luxury real estate deals in a major way, and it's creating new tax traps and opportunities you can't afford to ignore in 2025. Moving forward, we are diving into one of the biggest shifts hitting the luxury real estate market, crypto-only home transactions. Because just this week, Christie's International Real Estate launched a new division dedicated entirely to crypto-based property deals, including high-profile listings like an $18 million invisible house and a $118 million Bel Air mansion, priced in Bitcoin or Ethereum. Now let's talk about why this matters for active real estate investors and what the urgent tax implications are. Why crypto-only real estate deals are exploding. First off, crypto investors want anonymity and speed. They are bypassing traditional banking, wire transfers, and shell companies. When paying with digital assets, they can move value instantly and often avoid the scrutiny of multiple intermediaries. Moving on, major real estate platforms and institutional players are now accepting crypto because demand is high. This isn't fringe anymore. It's en vogue for high-end listings. But let's get to the tax implications, and there are many. How do crypto transactions impact capital gains tax? If you pay for real estate in crypto, you are triggering a taxable event. Here is why the IRS treats crypto as property, not cash. That means when you use crypto to purchase a property, it's treated as a disposal. You must recognize capital gain or loss on the crypto's market value at that moment. Further, if you hold significant gains in crypto and then buy into a high-cost real estate asset, you might immediately realize large taxable gains, even before the new property is ever listed or rented. Let's break it down. You buy Bitcoin for $10,000. It rises to $50,000 when you buy the property. You now owe tax on a $40,000 gain, whether or not the property itself is worth more or less. And if that gain pushes your income into the next bracket, your tax bill skyrockets. Moving on, many investors don't account for the fact that using crypto triggers IRS Form 8949 and Schedule D reporting, even if no cash hits your account. Cost segregation and depreciation when buying with crypto? Next, let's talk about what happens after closing. If your deal qualifies for cost segregation or bonus depreciation, you still get those deductions, but the calculation must start on the property basis, which becomes your crypto equivalent at closing. We must also mention this. Bonus depreciation is phasing down, 60% in 2025, 40% in 2026. So combining crypto gains with large bonus depreciation could significantly raise your deferred recapture risk. FIRPTA and withholding rules if you are a crypto investor abroad. Another thing investors often miss, FIRPTA rules. For foreign crypto holders purchasing U.S. real estate, the withholding rate jumped from 15% to 20% of the entire sales price in 2025, not just profit. That means if you pay crypto and you are foreign, the buyer must withhold more, even though no cash has moved. Without careful planning, you could owe tens or hundreds of thousands in back taxes or penalties. 1031. Exchanges and crypto purchases. Yes, it's possible, but tricky. Now, what if you want to do a 1031 exchange using crypto? Technically, using crypto to fund the replacement property is allowed, but you must treat crypto as boot and follow strict identification timelines and reporting rules. And if there is a crypto gain, your exchange could be partially disqualified unless structured perfectly. So let's talk next about best practices if you are going the crypto route on high-value real estate deals. Crypto real estate tax checklist for investors? Here is your checklist if you are investing in property with crypto. Track the cost basis of crypto carefully. Use transaction histories and adjust for forks or splits. Report every disposal, including crypto used to purchase property. Form 8949, Schedule D. Ensure cost segregation and depreciation basis reflect crypto value at closing for accurate recapture later. If foreign, adjust for FIRPTA withholding. Make clear the payment method and residency. For 1031 exchanges, treat crypto as boot and avoid disqualification by adhering to ID rules. Maintain records of wallet transfers, chain of custody, and exchange values to back up IRS audits. Tax planning strategies to optimize property acquisition with crypto. Moving on to strategy, here are powerful tax planning moves. Convert crypto to stablecoin or cash before closing to avoid unexpected gains at the point of sale. Pre-potentiate cost segregation studies to accelerate depreciation, but calculate your recapture risk ahead of time. Use installment sales or 1031 structures carefully if converting property or converting crypto after closing. For foreign investors, lock in the TEFRA election or escrow for FIRPTA withholding before signing the closing docs. If you are building large portfolios funded with crypto, this isn't a nice idea. It's a must-do principle to avoid capital gains surprises and IRS enforcement. Our recent real estate investor case study. Let's walk through a real example. Call him Investor A. He owns $2 million in Bitcoin, acquired years ago at zero cost. He buys a $10 million Beverly Hills mansion entirely in crypto via Christie's new division. At closing, Bitcoin is valued at $50,000 per coin. Investor A incurs $2 million in taxable crypto gain. If he is in the 20% capital gains bracket and California's additional 13.3% state tax, he owes close to $660,000 in federal and state tax. So there you have it. Crypto-based real estate deals are booming, and so are the tax complexities that come with them. If you are investing with digital assets or considering it, don't leave your tax planning to chance. Book a strategy call with Gavtax.com, and we will help you structure deals to maximize opportunity and minimize surprises. If this felt helpful, make sure to like, subscribe, and click the bell so you never miss an update. Thanks for watching, and we'll see you in the next one.